company is based in US. Okay, so as a usual practice, Jim Logan deposit the check with his local bank and request that the bank convert the check to dollar. Yeah, so they receive the check. So it could be denominated in pound, and then they will give the instruction to the local bank to, let's say, convert to dollar. And the local bank provide foreign exchange services because of you need to do the currency conversions. So therefore, they provide the foreign exchange services for their business customer who want to buy, who want to sell the currency. Okay, and then yeah, Jim Logan decided, however, they decided to check the quotations, the quotations of the spot rates, the spot exchange rate at other banks before converting the payment. Yeah. So why they want to check the quotation with other banks? Because of they want to be sure that the spot rate is reasonable. All right, and then of course they also want to ensure that the forward rate is reasonable. Because of, as you know that in last week, Jim Logan have studied. We have studied what determine exchange rate. So therefore, by looking at the rate that quoted by the bank, so actually you can see whether you can use the theory and estimate whether the spot rate is reasonable or not. So, and also you can do the checking like this. So you can make a comparison across different banks, maybe in different locations, okay, to see any differences. So actually, Jim Logan conduct this checking because they want to see in what conditions they can apply arbitrage. So I think you heard arbitrage before. So as long as there is the pricing differences between two locations or among more than two locations, then you can apply arbitrage strategy because of the price and the price being quoted differently, right? So you can buy low and sell high in different locations. That's the reason why Jim Logan would like to make a comparison. They want to check other banks how they make the quotations. Okay, so yeah, today we are going to study, and these are our learning outcome. We are going to study, and then at the end of this lecture, you shall be able to explain the conditions that will result in various form of international arbitrage. Yeah, so in what conditions can trigger international arbitrage? Yeah, so there are three types of arbitrage: locational, triangular, and covered interest arbitrage. So how you can apply these arbitrage strategies? So we need to know the conditions that will allow you to apply the strategy. And then to explain how the differences in pricing can be realigned after the arbitrage strategy. So the arbitrage is not a bad thing. Actually, it can make the market more orderly. So because of as long as there are differences, then you are going to see arbitrage exits. So with the arbitrage, so this will affect the demand and the supply. So at the end, maybe at the end the equilibrium, we are going to going back to the previous equilibrium exchange rate because of the arbitrage. The arbitrage will affect the demand and also the supply for currency. Okay, so through these adjustments, So we are going to like do the alignment, realignment, because of with when there is differences. So that means, so it will create maybe some kind of unhealthy competition. So with arbitrage, uh, then we are able to make the realignment for the foreign exchange market. Okay, so first of all, we are going to look at what is actually arbitrage. What is arbitrage? Yeah, so very simple definitions. So arbitrage means the arbitrageurs will capitalize on a discrepancy or a difference in quoted prices by making a riskless profits. So as long as there is a discrepancy, there is a pricing differences between two locations, between two markets, or maybe more than two markets. When you see the differences, then you are able to capitalize on the differences. Yeah, so this is arbitrage. So when you apply arbitrage means you are trying um, to buy from from a lower price and buy low and then you sell high. Okay, so because of you find that the prices are being quoted differently, and then because of the buying and the selling activity get triggered by the arbitrage strategy, so this will cause prices to realign. Yeah, initially, yeah, there is a difference between two markets, for example. Yeah, so one market selling at higher price, another market selling at lower price, and because of the demand, yeah, the demand increase in the market that's selling at lower price. So at the end, the price will increase. And then because of the supply or the demand decline in the market that's selling at higher price, so the price will decline. So at the end, will become realigned. So this is the alignment that triggered by arbitrage. Okay, yeah. So so this is the definition of arbitrage, and there are three forms of arbitrage: locational, triangular, covered interest arbitrage. Okay, first we look at locational. Locational. What is locational arbitrage? Where the arbitrageurs they capitalize on pricing differences in two locations. Like for example, in this case, the value of Malaysian ringgit quoted in dollar by a Malaysian bank. Okay, and the value of Malaysian ringgit quoted in dollar by a US bank. So according to the based on the theory, the value should be the same. The value, whether you get the value that quoted in the Malaysian bank and quoted in the US bank should be the same. Okay, yeah. If these two value are the same, then there's no arbitrage because of there's no price differences. But the thing is, you find that the value, the value are different when you make a comparison between these two markets, and then you can apply arbitrage, and this type of arbitrage is called locational because of we have two locations. And then they quote the value differently, so you can apply sell low, buy, and you can buy low and then you sell high. Okay, so you need to compare to to know whether which market offer lower, for example, lower value. So you have to make a comparison. That's why Jim Logan wish to check the quotation with other banks to see whether it's reasonable or not. Yeah, in other words, they want to check if there is opportunity for arbitrage. Okay. Yeah, let's look at this example. So if you look at this example, bank A and B, can you see the difference? Can you see the difference? So in bank A, what's the difference? Bank A, with 1 unit of ringgit, you will get $0.2255, right? Okay. And then in bank B, with the same unit of ringgit, 1 unit of ringgit, same unit, but you get slightly more dollar. Can you see that? Yeah, so this is what we call the pricing differences in different markets. Okay? So don't assume that all the bank in the market will offer the same rates. Because of why they offer different rate? Because of the cost of transactions. The cost of transactions that bear by different bank may difference, right? Yeah, you cannot assume that they have the same cost of transactions. Because of different cost of transactions, so the bank may offer different rates. So you don't believe, you can go and check. You can go and try and go around the commercial banks in Malaysia, for example, and or different money changes. Yeah, so you may notice these price differences. But of course, not necessarily every time you get this different rates. But I will say that you may find that some of the bank or some of the money changer, they provide slightly different exchange rate. Okay. So here you see the differences. Yeah, so the question will be, what will be the profit for the investor if they apply locational arbitrage? And then you are given 500,000 ringgit, and let's conduct location arbitrage and see whether you will get more than 500,000 or not at the end of the strategy. If you get less, then you lose. If you get more, then yeah. So this location arbitrage is worth for you to conduct. Okay. Okay. So we know there is price differences, right? So how are we going to do it? Yeah, of course. Here we have to make one assumption. Very important assumption is there is no transaction cost. Okay, so when you go from bank A to bank B, so we assume that bank A to bank B or bank B to bank A, so we assume that they are very close, and then there's no transaction cost for you. Okay, so if bank A is in Labuan, bank B is in Kuala Lumpur, then yeah, you may have to include the transaction cost. Of course, here we just assume that no transaction cost. Okay, so we can access to another market easily. Okay, so let's look at how we can start. So how are you going to start from here? You have to start from bank A, then bank B, or bank B, then bank A. You have two locations. So which one you should start? A or B? Can I have the response? A or B? Yeah, Joanna, B. Jocelyn, B. Atika, B. Yes, okay. Seems very good. Why you go for B? Because of you get slightly more dollar. With the same unit of ringgit, you get more dollar. So you should start B. And you should start at bank B because of you get more dollar. Okay, you make comparison. So you get more dollar, you start first. Yeah. So you start B, then through the exchange rate, 500,000, how much you get in dollar? So this is what you get in dollar after the conversions. Okay, so you get dollar, this amount. Okay, you get this amount of dollar, and then with the dollar, you're holding the dollar, then you go to bank A. Go to bank A and convert back to ringgit. And convert back to ringgit, how much you get? Yeah, you get more than 500,000. 500,000. And the profit is this amount minus 500. Okay, so you get more than 22,000, 22,000 ringgit. So you get profit. Okay, so just imagine you do a wrong strategy. You start from bank A. So what happens if you start from bank A? You can try, right? So you can try what if you make a wrong decision. You start from bank A, then you lose. For sure you will lose because of in bank A, you see or not, you get less dollar. But when you come to bank B, you need to use more dollar to get the same unit of ringgit. Yeah, can you see that? Yeah. So that's why just now Atika, Jocelyn, Joanna, they all choose B first. Yeah, it's a good choice because of first you get more dollar, and then when you go to bank A, you don't need to use all your dollar to get ringgit. You see or not? And in bank B, you get 0.2355. But when in bank A, you only need 0.2255 to get back the same unit of ringgit. Can you see that? That's why if you apply the right strategy, then you will gain the profit. Of course, here we assume no transaction cost. We make this example straightforward and simple. Okay, so that's why we have to, in economics, we have to make some assumptions. If not, if you include the transaction cost, that would make things very complicated. So just assume that no transaction cost, and then we can apply straight away the locational arbitrage when we see price differences. Okay, just to get the idea, the concept of this. Okay, yeah, you can try. I don't want to give you another calculation. You can try if you start from bank A, then I'm sure you will lose because of first you get less dollar, and then you have to use more dollar to get back the ringgit. Okay, so remember you must convert back to the ringgit so that you can make comparison. This is your initial investment. Initial investment is 500,000. So at the end you get more than 500,000. Okay, then you get profit. So this is locational. Nora Nisa, don't look at the exchange rate. Don't look at exchange rate. You have to look at the this time when I explain, you have to look at the value, the value of the ringgit because we are holding ringgit, right? Nora Nisa, Nora Nisa, don't just look at the exchange rate. Okay, I usually don't look at exchange rate high or low. I look at the value. Can you see that? That's why when I explain, I say, first in bank B, with 1 unit of ringgit, you get 0.2355. But in bank B, you get you need only less. You need less or fewer dollar to get back the same unit of ringgit. Okay, so you should start first. You should start from the bank or from the location or from the market that offer more dollar in this case. Okay, so in this case, so you'll find that your ringgit, the value of your ringgit here is higher as compared to the bank A. Okay, so here is it's better place for you to start first. So this is locational arbitrage, and I just want to show you the real world example. So this happened in 2000, in 2015. In 2015, that happened in China. So for information, renminbi, China yuan, can be traded in onshore and offshore. Yeah, so they have offshore market, so which which is in because of Hong Kong lah, because of Hong Kong is a financial center, so they provide offshore market for the transaction of renminbi. Okay, so what happened is before August 2015, there is a very serious price differences in the onshore and offshore markets. So the light color is represent the offshore market, and then this is the dark color represent the onshore market. So there is a very serious price differences. So as you know that when there is a pricing differences between two locations, okay, onshore, offshore, then arbitrageurs they could take this opportunity to buy low and sell high. Okay, yeah. So here they will buy from where? From offshore, because in offshore market the value of yuan is lower as compared to onshore. You look at the exchange rate. This is the exchange rate with dollar. So this is offshore. Offshore is 6.5 yuan for $1. Onshore is 6.4 yuan for $1. Okay, so as a arbitrageurs, yeah, so you can take this opportunity, and then you can buy the yuan from offshore and then you sell it in onshore. So if this is the case, what happened to the onshore China yuan? So they are going to face this depreciation pressure. And for information, China implement a less flexible exchange rate. Their exchange rate is not flexible, not 100% flexible. And if you look at what happened from this period of time, 2012 until 2015, you see their exchange rate is actually moving around this range, around 6 to 6.3. Okay, so the governments always intervene in the foreign exchange market because of China, as you know, that their capital market are not widely open. So they have to impose some kind of like less flexible exchange rate. It's not flexible enough. But it's not very fixed. It's not but they allow some flexibility. At the same time, they closely monitor. But because of this extra activity, so they feel the pressure. What kind of pressure? Depreciation pressure. So at the end, the central bank have no choice, because of if the central bank still want to defend their exchange rate, so the central bank have to keep on using their foreign reserve. Foreign reserve is actually limited. Even China, they have a very huge foreign reserve, but still they cannot keep using the reserve to defend their currency. So in the end, they let the China yuan to devalue in August 2015, and after devalue, you see they are no longer in this range, 6.0 to 6.3. Okay, they move out from this range. Yeah, so they, of course, after they devalue, so the central bank will have to determine the new range for them to implement the fixed exchange rate regimes. Yeah. So for information, China, they impose less flexible exchange rate regimes. So they have to. That's why their central bank have to always use the foreign reserve to defend their currency value. Okay, so this is one of the example that happened in 2015. Another example is actually happened to us in 2016, end of 2016, ringgit Malaysia. So we also having this problem, but our problem is slightly different. It's different with China because of ringgit. Ringgit is not allowed to trade in offshore markets, but still, of course, officially it's not allowed by the central bank. But outside Malaysia, there are activities. There are some kind of offshore activities. Yeah, that's why Central Bank of Malaysia have to step in, intervene, and ask the foreign banks in Malaysia not to trade ringgit in offshore. Now, why they do so? Because of central bank find that the exchange rate that traded in officially in onshore market is different with the offshore. And then arbitrages when the arbitrages see the price differences, yes, they will come in and then they will do the selling and the buying activities. Okay, so during that time, if you look at the exchange rate movement, you can check the exchange rate movement in the central bank. They do have the exchange rate, or you can look at the investing.com. So you find that at the end of 2016 and early 2017, yeah, so ringgit depreciated a lot. Okay, very close to, if I'm not mistaken, very close to 4.4. Okay, so that's why our central bank had to intervene. So this is one of their how to say, the interventions in the markets in order to stabilize the value of ringgit, because of the ringgit face depreciation pressure. So the central bank have to do something. Yeah, so this is another example of locational arbitrage. Okay, so any questions about locational arbitrage? Any questions that you would like to ask before I move on to triangular, when we have three currencies? Any questions? All right, so if no questions, then I think I should move on to triangular. So based on this, according to this strategy, so arbitrages, when they see pricing differences in three different currencies, then they will apply triangular arbitrage. Okay, so here we have three, for example, the value of ringgit in dollar, the value of China yuan in dollar, and the value of ringgit in China yuan. So you are going to have three currency and exchange rate. So the three currency ringgit, and then you have a dollar and China. And let me show you this example. One example on how we can apply triangular arbitrage. And then, of course, when we apply, we wish to gain the profit. If you don't like, no point for you to like. Okay. So look at this example. Assume that you have 10,000 ringgit for you to conduct triangular arbitrage. So what is your profit from this strategy? So here we have three currency, right? British pound, New Zealand dollar, and also ringgit. Right now, we have three currencies, and then we are given three exchange rates. Three exchange rates. Okay. So now we want to implement this strategy. So to implement triangular arbitrage, actually there's no specific strategy for us to follow. There's no specific procedure. So in this case, we have to look at what is your currency. You are holding ringgits. Okay, you are holding ringgits. So where you should start first? So you shouldn't start from here, right? Because of this exchange rate, you have no ringgits. Yeah, so therefore you shouldn't say that I want to convert from New Zealand dollar to pound, or from pound to New Zealand dollar. You must look at your initial investment. You start from ringgit, right? So you can either convert to pound or convert to New Zealand dollar. So as your first step. So your first step, you can, as I said, that there's no specific procedure. Okay. So here we have to try and error. Look at the options. Option 1, option 2. So you only have two options. Either you start converting your ringgit to pound, or in the second options, you're converting your ringgit to New Zealand dollar. Yeah, so we have only two options. Okay, and then there's no specific procedure. Okay, so we start from the first option. So let's say we convert from ringgit to pound, and then from pound to New Zealand dollar, and go back to ringgit. Okay, so in the triangular arbitrage, you must convert from your initial currency, ringgit, and then to pound, to the second currency, and then to the third currency, and then go back to ringgit. Why you have to return back to ringgit? Because you want to make comparison. After you go through this strategy, can you get more than what you have in your initial investment? So we only have 10,000. So after you do the conversion from one currency to another currency, to second to the third, and then you go back to ringgit, then you make comparison. Can you get more than 10K or less? If you get less than 10K, then this option is not worth for you to conduct arbitrage strategy. Okay, so we look at the first step, convert to pound, British pound. So British pound, the exchange rate is 5.5. Yeah, it's okay. Just now some students say that convert to New Zealand dollar. It's okay, no problem. You can convert to New Zealand dollar as your first option or first step. Okay. Later on, I can show you. Okay, so this is what you can get from the pound. From the conversions, you get pound. Because of the exchange rate is 5.5. Okay. Once you get pound, you convert to New Zealand dollar. So do you have exchange rate between pound and New Zealand dollar? Yes, you have this, right? So you can convert your pound to New Zealand dollar in the step 2. Okay. So you convert to New Zealand dollar. The exchange rate is 1.8. Then you get New Zealand dollar. Okay, as I say that, at this stage, you are still unable to tell whether you will get more ringgit or not. So you have to convert back, return to ringgit. Then you are able to see whether you get more or not. Yeah, so in this example, you get more than 10K. Okay, 10K, then your profit will be 473. Because of your initial investment is 10K. So after you do the conversion from the ringgit to pound, and then from pound to New Zealand dollar, then at the end, when you convert back to ringgit, then you get profit. Right? So option 2. So just now, students suggest why not we start converting New Zealand dollar as option 1. No problem, because of there's no specific procedure. So you have to try lah. You have to try, but don't worry. Only 2 options. Either option 1 profitable or option 2 profitable. Okay, so let's look at these options. You convert to New Zealand dollar, so the exchange rate is 3.2, right? And then step 2, convert to pound. So make sure you have to go through all the currencies, because you are given 3 currencies. Okay, so apply, then convert from New Zealand dollar to pound. So the exchange rate is 1.8, right? 1.8. Then you get this amount of pound. Then after pound, return back to ringgit. In order for you to see whether you get more ringgit or not. Yeah, so this option, you get less. So once you get less, means this is not profitable. So means option 2 is not profitable. So option 1 is profitable. So that means in order to apply the triangular arbitrage, so the right strategy is to what? First, you are holding ringgit as your initial investment, so you convert to pound, and later on you convert to New Zealand dollar, then come back to ringgit. Okay, so this will be the right strategy for you to apply. Okay, because the option 1 is profitable, so this will be the right strategy, the right triangular arbitrage strategy. So you understand that? Okay, and then don't worry, only 2 options. Okay, and then there's no specific procedure. So, any questions? So as I said just now, option 1 is profitable. So this is our conclusion. Any questions?
Sir, it's Ranisa. I have a question. So if Malaysian ringgit convert to other dollar, divide, but is it?
Oh, don't memorize divide or multiply. So you have to look at the exchange rate.
How, sir?
Okay, let's see. Ringgit. Ringgit, you convert to pound, right? So the exchange rate is what? 1 pound equal to 5.5. 1 pound equal to 5.5, right? And then you are holding ringgit. Correct? So 1 pound equal to 5.5. So that means this amount divided by 5.5, and then you will get the amount of pound. You get that?
Oh, okay, sir. I get.
See, look at the, it's just like you do mathematics, the maths. 5.5 equal to 1 pound. So and then 10,000 ringgit equal to how many pounds? You can use the mathematics across. All right. So like 5.5 ringgit, you see, 5.5 ringgit equal to 1 pound. And 10K equal to how many pounds? Okay. Yeah. So that's why 10K divided by 5.5. Then convert from New Zealand dollar, from pound. You are holding pound, and then now you want to convert to New Zealand dollar. So just now, if you look at the currency, and you look at the exchange rate, 1.8 New Zealand dollar equal to £1, equal to £1. And now you have how many pounds? You have how many pounds? 1818.2, right? Yeah, so £1 equal to 1.8 New Zealand dollar equal to £1. Now you have this amount of pound. So you have to multiply, right? Because of 1.8 New Zealand dollar equal to £1. Can you see that? Now you have this amount of pound. So of course times 1.8. And you get the amount of New Zealand dollar, right? And then you are holding a New Zealand dollar, you want to convert back to ringgit. So look at the exchange rate of ringgit and New Zealand dollar. So 1 New Zealand dollar, you get 3.2 ringgit. 1 unit of New Zealand dollar, 3.2 ringgit. And now you have how many New Zealand dollar? You have 3,000 plus, right? So just now exchange rate saying that 1 New Zealand dollar, you will get 3.2. So therefore here times 3.2, then you will get back your ringgit. Okay, so don't memorize multiply and also and when you have to multiply, when you have to divide. Okay, so look at the exchange rate. Look at the exchange rate, and then from what currency you need to convert. Okay, yeah. So I have no specific formula for this. Okay, I can't tell when is you need to multiply, when you use divide, but look at what currency you have, and then look at the exchange rate. Okay. So you must understand the exchange rate very well. That's why in the last lecture we learned foreign exchange market, so the exchange rate. Okay, you must know because of in the exchange rate you only have two currency. In you only have two currency, right? Yeah. So here you must know how to read 1 unit. 1 unit of pound, you can get 5.5 ringgits. 1 unit of New Zealand dollar, you get 3.2. Okay, and 1 unit of pound, you get 1.8. Okay, so exchange rate is very important in international business. And maybe because of now the door, the international borders are now open, so you can try and go for traveling. Then you will be more appreciate when you do the currency conversions from ringgit to another currency and so on. Okay, so is it okay? Understand? Don't memorize, don't memorize the there's no formula actually when you do the currency conversions. Okay.
Understand, sir. Thank you, sir.
Yeah. So it's a good news, no formula, because of if with formula you have to memorize. Yeah. Okay. Okay. Any other questions? If not, I will move on to covered interest arbitrage. Yeah. So under this arbitrage, arbitrageurs will capitalize on interest rate differential. Now, if you look at interest rate differential between two locations. Yeah, for example, here they will look at the interest rate differential between Malaysia and the UK. Okay, yeah. So this is how arbitrageurs they will monitor and see whether there's any interest rate differential. Yeah. So based on theory, if you have investment in different markets, like for example here in different markets, as long as they share the same risk as long as the risks are the same risk, then you should expect the same return, right? Because in theory we learn high risk, high return. Yeah, correct? Yeah, so if the risks are the same between two locations, then the return should be the same. Yeah, so this is according to the interest rate parity theory. According to the theory, interest rate parity, when you have two investment and then if these two investment provide the same risk, they face the same risk, then they should provide the same return. Okay, based on the theory. But somehow in the real world, so the pricing in terms of the interest rate could be different. Yeah, you may see interest rate differential between the markets. Why? Because of different markets or different country, they exposed to different kind of risk. Okay, like for example, those country now in Europe, so maybe they are facing higher risk of geopolitical, the geopolitical risk in that area. But in the other part of the world, yeah, maybe they are not exposed. They are not so exposed to the geopolitical risk. Yeah, so their risks are different. So therefore, they may provide different returns. That's the reason why Jim Logan wished to check the quotations. Okay, so let me show you this example on how to explain and how to understand parity in interest rate. Okay, so suppose an investor, you invest 1 ringgit. Make it very simple. I don't want to make it complicated. Actually, 1 ringgit, usually people will not invest only 1 ringgit. So million or billion. Just make it very simple. 1 ringgit in Malaysian security. Okay, so and then at the end of one period, so this one period could be after 3 months or 6 months or 1 year. So the total wealth will be your investment, initial investment is 1 ringgit. And then don't forget, at the end of one period, you will get take into account the interest rate. I is interest rate. Okay, yeah. So this is your wealth after the end of the one period on Malaysian securities. Okay, and then at the same time, alternatively, investor can also consider investment in other countries. So they can put 1 ringgit in US security. Okay, so they say if they invest in US, what happened? 1 ringgit, they have to convert to dollar, right? So this is S is represent exchange rate. S is exchange rate. They convert to dollar. So once they convert to dollar, then they invest in US, and then they are given the interest rate by the US security. And then after you get your investment return from US, you may convert back to ringgit. So when you convert back to ringgit, you have to refer to the forward rate, forward exchange rate. Why forward exchange rate? Because of that one is at the end of one period, after 3 months, 6 months, 1 year. So right now, can you get any spot exchange rate? No, because of spot exchange rate is immediate. It's immediate rate. So therefore, you need to estimate. You need to estimate the forward rates after, let's say, after 3 months, 6 months, or 1 year, right? When you convert back from ringgit, from dollar to ringgit Malaysia. Okay, so based on this, the theory of interest rate parity. So these two investments, as long as they exposed to the same risk, so in terms of the return, they are indifferent. There's no difference in terms of return. So that's why we have this equation, you see. Yeah? Your wealth in the US securities equals the wealth that you gain from Malaysian securities. Yeah, so here assume that if the risks are the same, they're exposed to the same risk and the same return. Okay? Yeah, so this is called interest rate parity. Interest rate parity. So both markets provide the same return. So no matter where you invest, in Malaysia, or you go here, you invest in US, you go for the currency conversions, and then you have to check the forward rates. Begitu susah payah, then at the end, same return. Yeah, so this is interest rate parity. So there's no arbitrage opportunity. No arbitrage opportunity because of arbitrages, they can't capitalize on interest rate differential. No, there's no difference. Yeah, so this equation can be also written in this type of equations. So if you look at this equation, you'll find that actually the future, the expected exchange rate is actually determined by interest rate differential. So the forward rate actually is some kind of our expected exchange rate. Okay, yeah. So you can see that actually the differential here. So the interest rate differential is important. That's why in our last lecture we learned what determine exchange rate. Correct or not? What determine exchange rate? Still remember? Interest rate and the interest rate differential, relative interest rate, is one of the factors. So this is one of the factors that determine exchange rate. Yeah, so this is where the theory come from parity, interest rate parity. Okay, so in this condition, again I repeat, in these conditions, there is no arbitrage opportunities. So you can't no matter where you invest, you get the same return. Okay, so we are going to look at in what situations you can apply arbitrage strategy. Okay, in what situations? So if this happen, so this is one of the situations, one of the conditions. If this happen, that means the return here is higher than the return in the US. Yeah, at the end, you find that, oh, the wealth in Malaysian security will be higher as compared to US securities. Okay, so you have to make decisions. You have to make the decisions on the financing and the investment decisions. So where shall you borrow and where shall you invest? Okay, because of usually we cannot assume that we use our own, let's say, own money to invest. So we may borrow from somewhere and invest. Okay, so in this case, where shall you invest? Okay, first questions. So you shall invest in Malaysian securities, right? Because of at the end of the period, at the end of one period, then the wealth is more than the that you gain from US security, correct or not? Okay, so for investment here, Malaysian security. So for the borrowing, so you shouldn't borrow here because of if you borrow in Malaysia, so they say the return, the interest rate, assume that the interest rate is 5%, you borrow, and then your investment is also 5%. Then that's it, no difference. Okay, so for the borrowing, You borrow from the US, and you borrow US dollar, for example. Okay, yeah, because of here, you see, yeah, so there's a difference. There's a differences in terms of the interest rates. Okay, so you could borrow the dollar. Yeah, so this is one of the conditions. One of the conditions. Of course, another condition will be the wealth in the US could be also more than ringgit, more than Malaysian securities. So if this is the case, so you invest in the US securities and you borrow from Malaysian market, so you borrow ringgit. So this, as I said earlier, is just one of the conditions that arbitrage just to apply interest rate arbitrage. Okay, so this kind of arbitrage is called covered interest arbitrage. Why is it called covered? Because of we have to deal with forward contract. Okay, now forward contract is one of the derivatives. Okay, yeah, so in this situation, there's no opportunity. There's no opportunity for you to apply arbitrage. And if there's a disparity, then you can apply. Okay. Covered yeah, so we have to also talk about the carry trades. So actually, the carry trade strategy where investor they borrow a given amount in a low interest rate currency. For example, just now, in this case, so investor they will borrow dollar and then they will invest in Malaysian security, and then they convert the fund into a higher interest rate currency, and lend the resulting amount in the target currency at the higher interest rate. Yeah, so they borrow here. So they borrow from, like for example, this borrow from the dollar and then invest. We invest in this like 5 months to Malaysian security. You conduct the lendings. So you borrow, you lend your money in Malaysian security. Okay, kind of activity is called carry trade. So it's very famous and common in actually in international transactions. Yeah. So as long as the arbitrages they see, then they will apply. They will apply this kind of strategy. Okay. So okay, but this strategy is actually I cannot say that this strategy can be applied without any risk. Okay, so as just when apply this strategy, so they actually exposed to some potential risk. Like what happened in 2014. In 2014, when the US Federal Reserve they give signal in 2013 that they are going to by the end of 2014 their interest rate. They will raise their interest rate for the first time in 9 years. Okay, so that was happened in the foreign exchange markets. So because of the market, they respond to the signal given by Federal Reserve in May 2013. Because the Federal Reserve they provide signal, they give signal. Okay, they are not going to implement the QE, quantitative easing, forever. So they are going to end it quite soon, either in 2014 or 15. So the market respond. So when the market respond and the demand for dollar increase because of when the US raise interest rate, for sure, the return will be higher. So the demand for dollar will increase. Yeah, because of the demand for dollar increase. So the dollar strengthen. The dollar strengthen. So what happened to those emerging markets economics, as well as those investors who borrow dollar? Initially, dollar actually is considered as a low interest rate currency. Low interest rate because of from 2009 until 2015, their interest rate is around 0 to 0.25. It's very, very low in the history. Okay, yeah, so many investors, including those from emerging market economics, yeah, so they borrow a lot of dollar. But if this situation, because of this situation, because of the signal given by the Federal Reserve, and because of the response by the market participants, they increase their demand for dollar strengthen, then emerging market economics carry trade will be in trouble. They are in trouble because of the currency value have increased. That means when you borrow the money, you have to return, right? You have to pay back the money. And then because of the dollar appreciates, means you have to use more currency to exchange for dollar. Yeah, so this is the problem of emerging markets carry trades during that period of time, 2014-15. Yeah, so they borrow very cheap, but the thing is, when they want to make repayment, oh, so expensive. Okay, yeah, so this is the potential risk, the potential risk. Okay, so any questions? Any questions? Before I conclude this lecture, any questions about the arbitrage? Okay, so if no questions, then I will go for the implications. What are the implications? Why arbitrage? Why arbitrage is so important for both investors as well as policy makers? Why they are so important? Okay, so for the investors, like for example, Morgan is not policy makers but investors. Yeah, so predictive conditions will help them to make optimal financial decisions. So here, what kind of financial decisions? Borrowing as well as financing decisions. So you can, through the predictive condition, you can decide, okay, where you should borrow currency and where you should invest. Okay, so this is for investors. They have to understand the predictive conditions theory. And then, of course, they need to do their own analysis. If you look at the research, the research papers, journal articles, so there are many research on research priorities. They are trying to estimate, they are trying to examine whether there is arbitrage opportunities or not. And then for the policy makers, why is so important? Because of so using according to the parity condition, they are able to evaluate the strength of their national currency. Because of just now, as I show you, using the interest rate differential, you are able to determine the future exchange rate. Yeah. So therefore, for the policymakers, yeah, so they can evaluate the strength of their national currency using the interest rate interest rate parity conditions. And then they also can evaluate whether their national capital market is efficient or not. If efficient means the capital can have the freedom to move in and move out easily. Okay, based on the parity conditions, actually we should have open capital markets. Right? So therefore, policymakers, they always do estimation, do examinations, and see whether there is a parity conditions or not, in order for them to examine whether their national capital. And then they also can evaluate the effectiveness of fiscal and monetary policy towards their macroeconomic policy. Because of central bank, especially central bank, they conduct macroeconomic policy. And then, of course, I think you learned it before when you are in the financial markets and institutions in the previous semester for both HE19 and 22. So you should know that what determine interest rate movement. Because of video, we know that in this formula, we know that interest rate differential is one of the very important determinants to the exchange rate movement. So therefore, from the domestic perspective, I mean interest rate movement. Okay, of course, we know that the interest rate is actually set by the domestic central bank. But how the domestic central bank set interest rate? So they will look at the potential economic growth, fiscal policy, inflations, and so on. Okay, so therefore, policymakers they can evaluate how effective is their fiscal policy and monetary policy in affecting exchange rate. Okay, because of these two policy affect interest rate movement, and for sure, they will affect exchange rate movement. So these are the implications for both investors and also the policymakers. Okay, so what are the key takeaways? So we have learned three arbitrage strategies: locational, triangulars, and also the covered interest arbitrage. Okay, and then as I say that arbitrage is not a bad thing. It's not something bad. As in fact, arbitrage will help the market to be like aligned, because of initially there's price differences. The price differences in two or more than two markets, or maybe there's interest rate disparity, for example, initially disparity. But because of arbitrage, arbitrage strategy will affect the demand and the supply on a particular currencies. So because of the arbitrage, then the value of the currency will be realigned. So this is as long as there's no as long as not speculative lah. If speculative activities, that means that one is not a very good sign for the market. But arbitrage actually help us to realign. Okay, just like every time you let's say you change a new tire of your cars, you go for realignments. So arbitrage help foreign exchange market to realign, for example, the value of a certain currencies. Okay, yeah. So this is the key takeaways. So we have learned three strategy, and the arbitrage affect the demand and also the supply of a certain currency, and then because of the demand and supply, so the value will be realigned again. Okay, yeah. So that's all for this lecture, as I think if you notice in the Smart D3, so after these sections, we are going to have a tutorial sections. So is there any questions? Oh yeah, I forgot to post the attendance link. Yeah. So next time you can remind me. You can remind me. Sometimes you can remind me. Don't be shy. You can remind me. So the link for attendance. So sorry for the late posting. So the link for attendance are now available in the chat box. In the chat box, so you can get the link for attendance for the lecture. Okay, this is for the lecture, and then for the tutorial, I will give you another link. Okay, lecture and the tutorial, we have different link for attendance because of different sections. So please sign the attendance. As I said that, you must sign the attendance because of this is compulsory to prove that you attend the lecture. Okay, can you get the link for attendance? Yeah, so this time I've forgotten to give you in the middle of the class. Usually I will give in the middle of the lecture. Okay, so you can remind me. Next time you can remind me in case if they say if you find that in the middle of the lecture I haven't give any link for attendance, just remind me. Okay. Okay. Please sign in your attendance for the lecture. So while waiting for you to sign in the attendance, any questions? Any question before we end the sections and then we go for the tutorial lah. Okay. Any questions until this part? Take away until the key takeaways. Any questions? Let me check your questions. Okay. Okay, if no questions, then we, as usual, we move on to the weekly top stories. Okay, so of course, I'm not limit to this updates. So